All right, so chapter 11, we are going to be discussing decision making and also utilizing relevant information in doing so. We have several learning objectives for this particular chapter. We're going to continue our use of the 5-step decision making process. We have learned that we have got to go through these steps. We're going to identify the problem and any uncertainties. We're going to obtain information. We're going to make predictions about the future. We're going to make decisions by choosing among our different alternatives that we have. And then we're going to implement our decision and then come back around and evaluate how that worked out for us, how we performed, and then learn from that, and then continue on with the process moving forward. We will distinguish between relevant information and irrelevant information in our decision situations. Many of you have had some of these topics in at least one, if not 2 or 3 prior classes to this one. So this particular chapter should be fairly easy for you. You're basically reviewing some things that you've seen in the past and possibly looking at a little more challenging problems than what you have seen in lower level classes. You will explain the concept of opportunity cost and why managers need to consider it when making decisions regarding insourcing or outsourcing products or services. So opportunity cost is typically one of the elements in this chapter that some students have a challenge with. So make sure you get opportunity cost down pat. You will definitely need to know how to choose which products to produce when there are capacity constraints. You should also understand how to manage or best deal with bottlenecks. These 2 particular issues, number 4 and number 5, listed here on the PowerPoint slide, I am going to discuss later in the PowerPoint presentation. Some books that you guys might want to look into purchasing or possibly getting them from the library and checking them out and reading them during your spare time in between semesters or even after graduation. If you plan on working in industry, I highly recommend these books. One of them is definitely called The Goal. It is by an author by the last name of Goldblatt, and I will look at the other 2 or 3 that are in the series and discuss those later when we get specifically to discussing capacity constraints and bottlenecks. You guys should, of course, be able to discuss the factors that managers must consider when adding or dropping customers or business units. So we're going to see some additional examples of this incremental analysis and decision making and relevant information on top of what you guys have covered in earlier classes. For those of you who have not had me for Principles 1 or Principles 2, the financial and the basic managerial class, I do some preaching in those 2 classes to the business management students. For those of you that may not really understand how the different majors veer off past the core curriculum at the College of Business, the business management and the finance majors and the others, those students typically, the last accounting class that they have is the managerial accounting, the ACC4060 or the Principles of Accounting 2 course. So it's very unfortunate, in my opinion, that they don't get dipped in a little farther with a little bit stronger. So I actually recommend to them that if they plan on climbing the ladder at those manufacturing companies or even a service company, that they really do need to take more accounting. And I tell them that they should take the budgeting class, the cost accounting class, and then this particular class, this advanced managerial class. And I also recommend that they should take a tax class because these folks are going to be making decisions and of course working with you all in the accounting capacity. So please be patient with them if they have not had all of the classes that you have had. We will talk about why the fact that book value, which you guys should definitely understand, is our historical cost minus the accumulated depreciation to date of our equipment, that is irrelevant, okay, because it is already been spent. It is a sunk cost. We're going to talk about sunk cost again here in this particular chapter and how we can ignore the fact that we've already spent that money on that equipment. All right, so we're going to consider lots of information, but some things we're actually going to ignore when we are making our decisions. We'll also talk about how that we could even have conflicts when a manager is going through and trying to make the decisions that we're going to see in this particular chapter. They could be tempted to not do the best thing for the company, but instead do something that makes them look like a better manager. Okay, so they're not going to necessarily make the best decision for the company. They may, in error, we could say, or in a bad way, make a decision that is going to just make them look better, but it's going to be adverse for the company. So we're going to consider what performance evaluation metrics could impose on a manager, and their decision making can be conflicted. All right, so decision models, we will be using the 5-step process. Managers usually follow a decision model for choosing among their different courses of action, and we're going to see a multitude of different decision possibilities throughout this particular chapter. So a decision model is a formal method of making a choice that often involves both quantitative and qualitative analysis. All right, so we've got some things that can be measured in numerical terms. Those are our quantitative items. All right, some of those can be financial or in monetary terms, but we can also have some things that are non-financial that can be measured numerically. Management accountants are the ones who are going to go about gathering up this information, analyzing our information, and presenting relevant data to the managers and guiding them in their decisions. Again, we're going to use the 5-step decision-making process. It is covered earlier in the textbook. If you need to go back and peek through those steps again, please feel free to pause the video and read through those, or even go back and look at the earlier chapters. So we have the concept of relevance, and of course an antonym for relevance would be irrelevant. All right, so we have got to decide what information is useful and what information is not useful. Relevant information has two characteristics. It occurs in the future, and it differs among the alternative courses of action. The most important line to pay attention to right here out of these two is it differs among the alternative courses of action. All right, so let's say we're considering taking an order from a customer. If we don't accept their order, our revenues are going to remain the same for what we typically normally sell. So if we normally have $500,000 in revenues, if we ignore an additional offer from another customer for another $100,000 worth of product, if we accept it, we would get an additional $100,000, which would be revenues of $600,000 total. All right, so if we reject it, our revenues are $500. If we accept it, our revenues are $600. There is a difference between the alternatives of $100,000. All right, so we're going to consider both. Revenues $500,000 versus revenues $600,000. We can do the same kind of analysis with our costs. All right. If we are analyzing make or buy a product that we sell, we can make it ourselves or we can buy it from another company and turn around and sell it to our same customers. Let's say it's $750,000 in revenues. If we make it ourselves, our revenues are $750,000. If we buy it from another company and turn around and sell it to our customers, it's still $750,000 in revenues. Under that scenario right there, we can ignore the revenues because it's $750 versus $750. Why go through all the trouble of calculating up the revenues if the revenues are the exact same under scenario A versus scenario B? All right, so relevant and therefore useful information needs to be different under the alternatives that we are analyzing. Again, relevant can be with revenues, and relevant can also be cost. All right, so relevant costs are the costs that are expected to change in the future, and the relevant revenues are expected future revenues. All right, and they need to change or be different amongst the alternatives that we're analyzing. If they don't change or if they are not different, we're going to ignore them because they are irrelevant. Past cost, as I mentioned earlier, things that we have already spent the money on. They are sunk. They are the historical cost. We will not be able to go and back in time in a time machine and get that money back and give that piece of equipment or whatever to whoever we bought it from. We cannot go back and change it. All right, so past costs are sunk costs. They are irrelevant. We're going to ignore those. We do have several types of information that we need to consider. Again, as I mentioned earlier, we've got those quantitative factors, those numerical, typically monetary type of issues that we can quantify them with a value. Of course, we are going to be considering those, but we also need to take into consideration qualitative factors. And we're going to look through these different scenarios and decisions that we need to make and consider some of the additional qualitative factors that could come into play in our decision-making process. For example, employee morale. For another example, quality standards of the products in question. Can the quality standards or the quality control measures be met or maintained? Those kinds of things are qualitative in nature. So qualitative factors are just as important as quantitative factors, even though many times they are difficult to measure. Again, past historical costs may be helpful as a basis for making predictions. We can use those past costs, looking forward, what we have spent in the past. We can use that data and information, but again, we cannot go back in time and change that investment. All right, so they're sunk costs. They're irrelevant. Different alternatives can be compared by examining differences in expected total future revenues and expected total future cost. Again, we're looking for the relevant information, relevant revenues, relevant costs, and comparing that information. We are looking to make the best decision for the company. And how are we going to make that decision? Based on bottom line. How is our net income going to be affected? Will those revenues increase or decrease our operating income? Will the costs or expenses be cheaper or more expensive going forward based on our decision? All right, we're going to look at those revenues and those costs under the different possibilities and make the best decision as to how it affects our operating income. As I mentioned already, not all expected future revenues and expected future costs are relevant. They've got to change or be different among the alternatives in order to be considered. If they don't change, we're going to ignore them. They can be eliminated from the analysis. We don't even have to go through the physical effort of calculating the numbers because it's the same under scenario A versus scenario B. Again, do not ignore qualitative factors. They must also be given consideration. All right, so we've got an example in your textbook, and we have got a company that is considering our possible reorganization. And I'm going to do a second set of PowerPoint slides for this particular one. So just pick back up with this second set where we're going to talk about making decisions and comparing relevant revenues and relevant cost